Okay, now let us move into our final part, which is the accounting of this particular standard. Okay, but before we move in, some of y'all might be having a doubt. Does impairment only apply on my tangible assets or my physical assets? Or can I apply it also on my intangible assets too? I would say, yes, it applies on both, on your tangible assets as well as your intangible assets. In terms of intangible assets, you all know when you all purchase a subsidiary, when you all purchase a company, you all need to calculate goodwill. Okay. And at each reporting date, this goodwill, which is an intangible asset, needs to be impaired under your IFRS 3 business combination standard. Don't worry, we have a separate recording that is going to come up and you all will be learning it in detail. Okay, but what you all need to remember is impairment is done on both tangible as well as intangible assets. Okay, in terms of intangible goodwill, in terms of intangible purchase goodwill, you all need to do annual impairment. We learned this in our previous recordings too. Okay. Now, moving into your accounting part. Impairment can be calculated under two different methods. One is your cost model and the other one is your revaluation model. Okay. Cost model, of course, till now, what we have learned is our cost model. Okay. What I'm going to teach today is your revaluation model. Okay, so let us look into cost model. First of all, let us have a recap of what we have learned so far. Say that your accountants have gone and shown your asset carrying value as $180. Okay. In terms of recoverable amount, now you all know what is recoverable amount. Recoverable amount is the maximum amount that an asset could generate by either selling that asset to a third party or using that asset in your business and generating future cash flows in terms of profits. Okay. So recoverable amount can be computed. Recoverable amount can be computed as the highest among fair value minus cost to sell and your value in use. You need to take out of these two components the highest one. Okay. So based on the given figure, out of 100 and 150, I feel that 150 is the highest. So my recoverable amount is 150. Now moving on to your comparison. See, what has happened here is our accountants at the reporting date have gone and presented that the carrying value of the asset is 180. But this asset can be sold in the market only for 150. Or this asset can be used in your business and generate future profits of only 150. Don't y'all think that this our accountants have overstated the asset by 30? The asset is only valued in the market. I could only sell it to a third party for 150. But what has happened is our accountants have gone and recorded it or have gone and presented it as 180. So there is an overstatement. And you all do know very well when there is an overstatement, you all need to do impairment. Okay, you all need to do impairment. So in terms of 30, the double entry of impairment would be is you all need to debit your impairment expense. Why? Because it's an expense of 30. And also, you all need to credit your property, plant, and equipment or the asset by 30. The reason why I'm telling you all to credit your property, plant, and equipment is again, see, our accountants have overstated it, right? We need to bring it back to its actual market value. So therefore, you need to reduce your asset. You need to, sorry, give me a minute. You need to reduce your asset from 180 to 150 to bring it back to its actual market value. So that is the reason you all need to credit your property, plant, and equipment. Now, in terms of your cost model, what you all did was you all always, if there was an impairment expense, you all expense it fully in your profit or loss, right? The entire impairment expense was directly taken to your profit or loss as an expense. That is under your cost model. Now let us look into a new thing which is called as your revaluation model. Okay. What does revaluation model say is, the impairment expense, rather than directly taking to your profit or loss as an expense, you can deduct it from your other comprehensive income. Or in other terms, you can deduct it from your revaluation gains. Okay, so don't worry, since this concept is a bit new, let us build it a bit by bit. Okay, by referring to this question. Okay, an entity owns a property that was revalued to 500,000 on 31st March 2003 with a revaluation gain of 200,000. Okay, being recognized as other comprehensive income and recorded in your revaluation surplus. Okay, so what has happened is they have made a revaluation gain, and that has gone and been recorded under your revaluation reserve, which is in your statement of changes in equity under the narration of other comprehensive income. Okay, this is as at 31st 3rd 2003. Okay, at 31st March 2005, the property had a carrying amount of 460,000. So this is after 2 years, after a revaluation happened, after 2 years, what is happening is at your reporting date, your accountants have gone and recorded in your books that the asset, according to them, is valued at 460,000. Okay, but the recoverable amount of the property was estimated only 200,000. But in real life, what happened is we only can sell it to a third party and generate only 200,000. So don't y'all think that there is an overstatement. Don't y'all think there is an overstatement of 260,000. Why do I tell it as an overstatement? See, I only can sell it to a third party and generate only 200,000. But our accountants have gone and stated it as or overstated it as 460,000. So therefore, an impairment of 260,000 has occurred. Now, since we are using revaluation model, the accounting treatment is a bit different in terms of your cost model. In cost model, what we intended was the impairment expense was directly taken to your profit or loss, right? Debit expense, credit property, plant, and equipment. But in revaluation model, this will not happen. In revaluation model, this thing will not happen. You will not directly expense it to your profit or loss. Rather, I'll tell you all how it's going to happen. You all know, right? Initially, you all had a revaluation reserve which had 200,000 revaluation gain. That gain will be deducted first. Always. If there is a balance, always remember, if there is a balance in your revaluation reserve, right? Balance means it's a gain. If there is a gain, then this impairment will be set off against that opening balance gain. Okay, so in this particular question, we saw that there was an opening revaluation gain of 200,000. So our impairment of 260,000 will be set off against this. first, right? Can you see I'm debiting? I'm debiting my revaluation reserve means obviously it's reducing. Okay. Then out of my total impairment expense, which was 260,000, 200 was allocated or 200 was scrapped off from your revaluation reserve, right? And then you have an excess of 60,000, right? That, as usual, you can debit your profit or loss and credit your PPE. Now, you all can ask why there's a difference in both the accounting treatments. See, earlier when we in cost model, under cost model, we directly expense off any impairment, right? If we had an impairment, that was directly taken to a profit or loss. You did not bifurcate it or you did not allocate it. But in your revaluation model, what you all need to understand is if there is a revaluation balance, if in your revaluation reserve there is a gain, right? Then your entire impairment cannot be directly deducted from your profit or loss. What you all need to do is if there's a revaluation gain, if there's a revaluation gain, first you all need to set off your impairment against that gain, right? And if there is any excess of your impairment, that only will be taken to your profit or loss as impairment expense. Okay, so this is the difference between your cost model and your revaluation model. Okay, in summary, if it's a cost model, what you'll do is you directly take an expense into your P&L, regardless of any of the amount. You don't need to allocate, you don't need to bifurcate, or you don't need to divide. But in terms of a revaluation model, if there is a revaluation gain, then your impairment expense first needs to be set off against your revaluation reserve, and any excess after deducting from your revaluation reserve will be taken to your profit or loss as usual impairment expense. Simple as that. Okay. Now we are moving into your final part, which is known as reversal of impairment. Now be a bit focused. This part is crucial. Okay, so be a bit focused. Don't worry, give us about 10 minutes. We soon try to sum it up and wrap this session soon. Okay. Now, why do you all do impairment? Why do you all do impairment? We do impairment because we fear that in our future, the market value or the recoverable value of the asset would fall. That is the reason why we do impairment, right? So now to come up with the impairment, every year you all know we will not do impairment. If there is an indicator, if there is an indicator in the future, then only we'll be doing impairment, right? Now all these indicators, whether it's an internal indicator or whether it's an external indicator, all these are judgmental, right? All these are based on our expectations. Do you all think that it is 100% we can 100% there's a probability of what we expect would happen in the future? No, right? Sometimes what could happen is your actual events will be better than what you predict. See, we initially expected that our market value in the future, say about 2 or 3 years, would drop. I totally agree. That is why we did impairment. But actually, what happened in the future was they did not drop. What they did was they increased. The market value increased. That is when you all need to do reversal of your impairment. Logically think and see, whatever we expect won't happen in the future. Sometimes you will have favorable situations coming in, like your market value increasing rather than decreasing. Then you all need to do your reversal of impairment. Okay, so let me show you. Okay, see, there are some indicators. There are some indicators that you all need to be aware of. Okay, so let me show why one by one. Increase in the assets market value. Okay, we do impairment because we feel that our market value would reduce. But in future, what do you think? What if it increased? Then you all need to reverse your impairment expense. Then you all need to cancel off whatever you all showed as impairment expense, right? And how does your assets market value increase? say there was a decrease in your interest rates. You see, decrease in your interest rates, or in terms of your technological aspect. Early Apple used to release each and every year an iPhone. That is the reason where our asset became obsolete, right? But now what Apple is doing is they are not releasing each and every year. They are taking 2 years, 3 years, 5 years to release, right? In terms of your legal environment, earlier government had import restrictions of bringing in the asset. That is the reason why our market value fell. But now government conditions become more favorable towards the business. They do not restrict, right? Then you all need to reverse your impairment. Okay. You all can ask what will be the double entry of reversal of your impairment. Okay. The double entry is just 2 line item. What you all need to do is earlier, you all debit your impairment expense, right? That has to be cancelled. Then obviously you all need to credit. You all need to credit. And the narration would be reversal of impairment expense. Now this will be shown under your other income always. Okay. And finally, where will you go and debit it? Where will you go and debit it? See, when you all did initial impairment, what you all used to do is from your cost, you all minus the impairment, right? That you all reduce the cost of the asset. That needs to be increased. That needs to be increased. So the double entry is simple. If there is a reversal of impairment, your impairment expense, which was a debit, needs to get credit, and you need to debit your property, plant, and equipment. The reason why you're debiting your property, plant, and equipment, because of the impairment, initially what you all did was you all went and decreased the value of your property, plant, and equipment. Now, since there is no impairment, your property, plant, and equipment, you all need to bring it back to its original cost. Now, for the people, what you need to understand is you all might be having a doubt. Because I reversed my impairment, do I need to go and reverse my depreciation as well? Why? Because my depreciation that I have calculated now is after removing the impairment. Well, for those people who think in that particular perspective, your path is correct. Okay, your thinking process or thinking pattern is correct. See, what happened is because of impairment, we had a cost of 100. Okay, for an example, you had a cost of 100. From that, you will go and deduct your impairment expense. So because of that, your cost would reduce. And because of the reduction in cost, your annual depreciation also will fall. Okay, how am I telling it is going to fall? How am I telling it's falling is, here see, if hypothetically think there was no impairment, then my cost is only 100. So 100 divided by your 4 years will give you all depreciation of 25,000, right? But because of me incorporating impairment, I was able to save 5,000 from my depreciation expense. That is before your reversal of impairment. Okay, you are able to save 5,000 depreciation, right? That is what I mean by your reduced depreciation. Now, at present, what we are doing, we are planning on reversing the impairment, right? We are planning on reversing the impairment. When you are doing reversing in impairment, you all don't need to go and reverse the depreciation also. Never ever have that thought. You all never don't need to go and reverse your depreciation also. Okay. The reason being is after you all reverse the impairment, okay, after you all reverse the impairment, you all will anyway bring the asset to its original cost. Okay, after reversing impairment means there is no impairment at all, right? So you all will be bringing the cost to its original value. Then you all will be ending up at a revised depreciation of 25,000 itself. So then what happens is in terms of a financial impact of depreciation, Earlier, you all were able to save 5,000 as depreciation, right? Now, after reversing, right? After reversing, you all need to pay an excess of 5,000. You all need to pay an excess of 5,000. So plus 5,000 and minus 5,000 would set off, and there is no financial impact. There is no financial impact in terms of your depreciation when you reverse your impairment. Okay. For the people, this will be totally new. So what I want you to do is at this particular point, pause your recordings. Think with impairment, what was your effect? And think without impairment, what will be your effect? Then come and look at this part. Probably be able to be even more clearer, right? So I'm giving you all a summary here. I'm giving you all a summary here in terms of your depreciation. If there is a reversal in impairment, it does not mean that you all need to go and reverse your depreciation. No. As soon as you reverse your impairment, your cost will be brought into its original form, right? Because of that, your depreciation will be revised and it will be increased. Okay. You see, that is what I'm telling you. It will be revised and it will be increased, right? So whatever that you all saved earlier because of the impairment in terms of depreciation would be charged now. So plus 5,000, which was saved, minus increase in your depreciation expense would give you all a zero impact. Okay. Think properly, think slowly in your mind or do mathematical calculation in this perspective, you will be able to understand it even more further. Okay, now let us see how do we do a reversal of impairment in a question. Okay, okay. Now let me tell you all a story and just listen and we'll try to develop the concept bit by bit. Okay, in your year zero, okay, initial year, you all had gone and purchased an asset which had a cost of 10,000. Okay, useful life is 10 years. Then obviously per year depreciation would be 1,000 per year. Okay, then now you all are moving towards your first year financial year end. Okay, then obviously you all know your carrying value would be 9,000. How did I come up with 9,000? It is 10,000 was your initial cost. You minus your 1,000 per year depreciation. You come up with your carrying value as 9,000. But in your year one, what happened was you all had a indicator of impairment. The reason why you all had an indicator of impairment was because there was a reduction in the market value of the asset. Okay. So they found out the recoverable value. The recoverable value was 5,000. Now, as we know, when our carrying value is higher than the recoverable value, or in other terms, when our carrying value is overstated beyond the recoverable value, we need to charge impairment. We need to charge impairment of 4,000. In this particular question, is 4,000. Okay. The reason is simple. We can only sell the asset. Maximum we can sell it to a third party is only for 5,000. But our accountants have gone and presented it as $9,000. Okay. So there is an impairment. Okay. So the double entry was debit your impairment expense and you credit your property, plant and equipment. Simple as that. Okay. Okay. Now, you all know your year one carrying value is wrong. You all know your year one carrying value is wrong. Why? Because we have overstated the carrying value. Because we have overstated the carrying value. Okay, so this figure is wrong. So what I would do is I need to go and revise my carrying value. I need to go and revise my carrying value. Okay, instead of using 9,000 as my year one carrying value, I would take 5,000, which is this figure. Okay, so now until year one, now our carrying value or new carrying value is 5,000. So based on that new carrying value only, we are supposed to calculate new depreciation. We will not charge our previous 1000 depreciation. Why? Because it is wrong now. Okay, it is wrong. Okay. So obviously you all are in year one. You all initially had 10 years of useful life. After that, 1 year was fully utilized. Then you all have remaining 9 years. So each year you all will be having a depreciation of, you will be having a depreciation of 555. Okay. How did I arrive at 555? It is your carrying value, which is 5000 divided by your remaining useful life. Okay. Okay. So now year one was finished. We calculated depreciation. We calculated our revised carrying value. Okay. We charged impairment. All of those were done. Now we are going to a fresh new year. The opening balance was 5000. Your carrying value opening balance was 5000. Okay. Why? Because we went and revised our carrying value, right? Okay. From that, we will minus our second year's depreciation also. We'll minus our second year's depreciation also. And you will be arriving at a net book value or net carrying value of 4444. Okay. Until year two, it's simple. This we have learned it in our previous recordings. Okay, this is normal impairment method. This normal impairment method, a bit of depreciation is added into that. Okay, now something unexpected is happening in year three. Until year three, what we expected was our market value is going to fall, right? Because of that only we did impairment, we found out recoverable value, we adjusted or we revised our carrying value, we found out a new depreciation. All of this treatment was done under the basis of we thought that our market value is going to fall in the future. But in year three, what happened is, yes, see, instead of falling, instead of your market value falling, your market value increased, right? And we have learned if your market value increases or if your market value is more than your carrying value, then you all need to do a reversal of impairment. Okay. Now I'll show you all how it happens in year three. Now don't ignore all year zero, year one, year two. Those are irrelevant. Year three is only specifically related to your reversal of impairment. Okay. Now I'm telling you the story again. Okay. Okay. So we know our year two carrying value will be our year three's opening value. Okay, which is 4444. From that, you will be reducing your annual depreciation, which is 555. Okay, and you will be ending up with a carrying value of 3889. Right, your carrying value is 3889, but your market value is now in year three 4000 rupees. It is 4000 rupees. So now you all need to understand in this year three, your carrying value is not overstated, right? It is not overstated. So you all don't need to do any impairment, nothing at all. What you all need to do is you all recognized at this point an impairment, right? That needs to be reversed. That needs to be reversed. Why? Because now in year three, our assumption has changed. Our assumption has changed. What we thought until year three, year four, year five, our market value will fall. That is the reason we did impairment, right? But unfortunately, we had a favorable moment in year three. Our recoverable value was more than your carrying value. So therefore, you all need to do reversal. Okay. Now, most of the students get stuck in your reversal of impairment part, right? What they would do is they would just compare your carrying value and the recoverable value. The difference, they will be considering it as reversal, which is wrong. Okay, let me tell you all why. See, reversal has a limit. Okay, y'all cannot, just because y'all have a reversal of impairment, y'all cannot go and reverse it at any amount y'all want. Okay, that is, y'all will be misleading your shareholders. Okay, so there is a limit, or there is a board, I would say. How do we arrive at that limit is, how do we arrive at the limit is, the maximum limit, I would say the maximum limit is the carrying value without your impairment. Okay, I'm again repeating. Normally, our students, what they try to do is, if there's a reversal, they just compare the carrying value and they'll compare the recoverable value. The difference, they'll take it as impairment. That is totally wrong, because there is a maximum limit. Okay, there's a maximum limit that you all need to follow. Okay, so how do you all determine the maximum limit? How do you all determine the maximum limit? The maximum limit is your carrying value or your net book value without impairment. Okay, without this chunk. Okay, we know the cost was 10,000. We know the cost was 10,000. Without impairment means you all just need to do your depreciation. Right? We know the cost was 10,000. 3 years depreciation per year was 1,000. Per year was 1,000. So 3 years would be 3,000. So your carrying value without impairment is 7,000. Right? And this is a maximum amount, or this is a maximum limit. Right? So y'all are only allowed to reverse until 7,000 rupees. If y'all reverse anything that exceeds 7,000, then y'all are wrong. Okay. Now let us look at this instance. Let us look at this instance. Look at this question. We found out the maximum limit is 7,000, right? We found out the maximum limit is 7,000. Okay. The recoverable value was 4,000 and your net book value at year 3 was 3,889. Okay. So how much will we be reversing? We will be reversing an amount of 111. Now, this 111 will fall under your 7,000 limit. So therefore, this is allowed. Therefore, this is allowed. Okay. Let me give you all another scenario. Let me give you all another scenario where this amount won't be allowed. Say a maximum limit was 7,000 again. Right? This time, your recoverable value was 8,500. Your net book value was 5,000. Now tell me, until how much can you all reverse? Until how much can you all reverse? You all know y'all are only allowed to reverse until the maximum limit. Always fix it in your brain. You all are only allowed to reverse until your maximum limit, which is 7,000. So therefore, your reversal of impairment would be 2,000, which is a reversal of impairment. Okay, so the double entry of that would be debit and credit. Since this is an income, reversal is an income, you'll be showing it under other income. And you will be debiting your property, plant, and equipment of 2,000. Okay. In summary, what you all need to know, if it's a reversal of impairment, you all are allowed only to reverse until your maximum limit. Okay, you all are only allowed to reverse until your maximum limit. How do I find out my maximum limit? How do I find out my maximum limit? It is your carrying value without impairment. Okay, it is your carrying value without impairment. In this particular question, our carrying value without impairment was 7,000. Okay. In both the cases, scenario 1, scenario 2, it's 7,000. If your reversal figure, that is your carrying value minus your recoverable value, is within your maximum limit, then that amount is allowed. But in scenario 2, our reversal amount or the recoverable amount is more than your maximum limit. Yes, see, can you see? So this part is not allowed. This part is not allowed. Can you see my red line? It is not allowed. You all can only reverse. You all can only reverse until this part. Okay. Don't worry, we have questions coming up. And if there's a relevant question, I will be including that in your next recording, upcoming recording. And your final part would be in terms of your impairment. You all need to understand, you all can never reverse your impairment of your goodwill. Right? Now, for this particular part, even I did not know the answer till last week. That's when I prepared the notes. Okay, then I checked in ChatGPT. Why cannot I reverse my impairment of purchased goodwill? Okay. Okay. Now you all need to understand, why do we reverse an impairment? Because the market value of that asset is increasing, right? Now look at the perspective from the perspective of goodwill. Look at on the perspective of goodwill. How do you all think your market value of your goodwill would increase? It is when you all have better internal management or better staff. It is when you all have better internal quality of service, right? So now you all need to understand, under IAS 38, okay, this is how I'm linking the standards. Under IAS 38, we are not allowed to show any internally generated asset, right? So as we know, this market value is solely increasing because of our internal staff management. It is increasing because of our internal customer service. That is why we cannot reverse our impairment in terms of purchased goodwill. In summary, you all cannot reverse your purchased goodwill impairment. The reason is because that is considered to be an internally generated goodwill. Okay, under IAS 38, you all cannot take internally generated goodwill as an asset. So therefore, you all cannot impair it. Okay, that is it for the day. If there's any doubts that you all have, please feel free to ask. And this particular part, in terms of your limit and all, try to understand it. If you all are having any trouble, please feel free to WhatsApp me. Okay, thanks a lot.